gates in terms of the number of stocks are higher and lower, and the heat map should come up on your screen as well. Oh boy, I mean, I think we're getting used to like 5-point opens, right? 5 up or down. It's just, I mean, moves have gone away. I think, 15 odd names are lower and about 30-35 names are higher. So that's the overall state of play as things stand right now. Grand total of 2 points on the Nifty as we start this morning. Surabhi.
Oh, numbing that 7-8. Wow, it's a big move, isn't it? All right, let's look at the names first on the downside. Tech Mahindra, market is giving it a thumbs down. The margin is intact. In fact, it's 20 bips higher than the previous quarter, but the market is focusing on growth and that's lacking. The constant currency revenue decline is more than what was anticipated. So that stock is lower. ICICI Bank is lower. SBI Life has started on the lower side. Some other tech names like Infosys and Wipro are also losing ground. TCS is down by about 4-5 rupees this morning. So tech is largely on the lower side. Banks are sitting on the fence. ICICI Bank and Axis lower. Kotak Mahindra Bank is absolutely flat. HDFC Bank is also not doing much. The only real counterweight is actually SBI, which brings me to the upside of the screen. State Bank is managing a 1% up move, offering some sort of a counter. Apart from SBI, stocks on the upside would include names like Hindalco. There's a little bit of buying in Eicher Motors, NTPC, Tata Consumer. Nothing to report because, beyond this, the Nifty stocks are not even moving 0.5%. That kind of a flat morning. 5 lower on the index. Nigel?
Well, that's right. From the broader markets, actually, the stock today is Lurch Avenues Tech. We'll get the management in the next 60 to 80 minutes from here on. But that stock is firing away. The street likes the growth out there that they've delivered. We'll have to quiz them a little bit more on how they see the trajectory moving and also what is their market share. But that's the stock of the morning on the upside. A couple of other notable movers. SCI Land and Assets, that stock as well has moved up. So just keep an eye out on that name, moving on rather large volumes. The other one is Tilaknagar Industries. Yesterday, the stock was firing with all cylinders. And now, just a few minutes ago, they have uploaded the court order where they say that they have successfully established, the court has successfully established its proprietary rights in the trademarks Mansion House and Savoy Club. So yesterday, the stock, I think, was up 10%. Today, it's followed up with another 2% because the official order has just come. And they've been, they say that the court order has restrained allied blenders and distilleries from launching the brand Mansion House and Savoy Club in the markets in India. So the fear was that allied blenders will use the Mansion House brand. For the time being, it's come in Tilaknagar's favor. I recall when, that order came, the stock had corrected, I think, more than 15% in a single trading session. So Tilaknagar Industries is following up yesterday's big move with another 1.5% because the official order has come on the, on the BSE and NSE. JTL, those numbers were disappointing. Though if you look at it on, on a quarter-to-quarter basis, there is some improvement. But in the last 1 week or so, the stock actually had bounced up big time. So maybe the street was sniffing a better set of numbers. That didn't come about. Edelweiss, well, that's down close to around 1.5%. Volume's quite large out there. So that's why I'm highlighting that particular name. Aegis Vopak, just take a look at that. That's the new listing. I think it listed around 220 to 30 rupees. That's moving to around 300 rupees. Massive volumes out there. And AWL Agribusiness, that is well up 3.5%. We spoke to the management just 2 sessions ago, post their numbers.
Oh, absolutely, Nigel. By the way, yesterday as well, I think I saw the Wari 2 names. Wari stocks. Wari today is the #1 volume-led gainer right now. It's up just 4%, but it's got humongous volumes. Yesterday as well, I think that was the case. Not this one, the other one. This is Wari Energies.
Wari Renewables.
1246. There you go. That's the one. Look at the volumes on that one as we begin the session. Ixigo, by the way, is up 10, but volumes are also very, very large. Don't see that in the top 5 as far as volumes go, but it is. Sammaan Capital is at number 3, 3% higher, 133. I think Sammaan found its way into Nimesh's chatter list a couple of days back. So we'll keep an eye on that one. Glenmark, of course, we've been highlighted. PNC Infra is up 5%, 326 large volumes. Thermax is up 3%. So it's actually starting out like a pretty healthy, volume-led kind of day. So it's just still very early, 2 or 3 minutes into market open. But you get a sense that things will pick up more as we kind of go down the line. TechM is down 1.5%. So it's the biggest volume-led loser at this stage. And RBL is down 1.5%. And ABB is down about 1.25%. And so on and so forth. Deccan Cements, right? I mean, I think that's the other one. Had a big move yesterday. There was the buzz that a large group is going to buy it. But I think it's down about 2.5%. I think just sort of a little bit of pullback, a little bit of profit taking after what we've seen over the... actually, yesterday. Yesterday was the big move. So, but it's got volumes, 145,000 shares. And we'll see. JSW, right, Nigel? That's the buzz.
I know. I'm not taking any names, listed, unlisted. We don't know. And, on Deccan Cement, we've heard it in the past. We'll have to see how that goes when the earlier promoter as well was there, who now, in fact, the daughter has taken over the business. And then I believe the next generation as well is in it. So we'll bait buy for that. But the point on Waaree Renewables, volumes in the last couple of days are more than a crore. Normally, you see just 1 to 4 lakh shares getting traded. So massive volumes on
Results
that particular
today
name.
also, by the way.
Yeah.
So let's see.
Yeah.
Absolutely. For everything said and done, it's 9:21. So 6 minutes into market opening, we have a 10-point change on the Nifty. 7 points, actually, to be precise. Trideep Bhattacharya is with us, Chief Investment Officer, Equities at Edelweiss Asset Management Company. Trideep, good morning. Good to have you here. Thank you for your time. We're in the earnings season, so I guess we lead with that. IT, not really all that great. And maybe a little bit more in terms of deceleration before things turn. Banking, there's going to be margin pressure as numbers start to pour in over the next 2 weeks. And maybe estimates, overall full year estimates will have to be brought a little lower compared to where they are. In that relation, where are markets according to you at an index level? Remarkably stable. There's a lot of money which keeps coming in. There's a fair bit of supply as well. So it's almost in a unreal equilibrium so far, Trideep.
Yeah. Morning. Thanks for having me on your show. I would say, you have to see the current quarter results in the context of what India has been going through for the last year. So there's been an earnings downgrade cycle which has been prevalent in India since actually middle of last year. And I think the current quarter is symptomatic of that. That by and large, whether it is IT or for that matter, consumption or financials or all the larger sectors, I doubt if we see major earnings upgrades on a net balance basis. There could be companies who could have earnings upgrades overall on an individual basis, but unlikely to see upgrades on a holistic basis. So that's where we are. And that's the reason why the markets have kind of, after reaching closer to September odd levels, September last year's levels, are kind of taking a bit of a breather. The good news is in this that the economic decision making, which is the fodder for ultimately earnings over a period of time, has started coming through since the beginning of this year. Liquidity conditions have started easing. But all of these takes a bit of time to kind of get percolated into earnings. So my sense is that this earnings downgrade cycle will finally end probably as we get towards the back half of this year. A couple of sectors will actually lead that. But till that time, I think particularly in the quarter that you are seeing results right now, I would expect a fairly kind of lackluster earnings on the whole. The commentary will reflect a bit of optimism. And external facing companies would actually allude to more, or they are alluding to more uncertainty with regards to tariffs not ending. When we had this beginning of this 90-day window, we thought that by the time we get to the end of 90 days, there will be clarity. But at the moment, we still have deals, but not agreements. So that's where we are right now.
By the way, I just want to point out, let's pull up Lead Revenues Tech Ixigo once again. And it just kind of underlines how hungry this market is for growth. And wherever it sees growth, it's willing to latch on because there aren't too many growth opportunities present when you're looking at numbers these days. For Lead Revenues, the revenue is up 73%. The margin, one can argue that the margin's actually down 100 basis points year on year. But for the time being, profit is up about 27, 28% as well. For the time being, the market is just looking at, here's a company that's at least delivering 70% kind of growth in a sector that anyway seems to have a lot of tailwinds. Trideep, hi, morning. I remember you saying that you actually like this space, this way of playing discretionary consumption through lifestyle, leisure, travel. Give us your sense. What kind of stocks, or are you still overweight on this part of the market, hotels, etc.? Because that's the problem. You need to find pockets where there is at least growth.
Absolutely, and I think relatively, whether you take look at three pockets, selective pockets where we are positive on. would be kind of in a broader level of consumer discretionary, which will be hospitals, hotels, capital markets. These would be three areas. These are small parts of the overall market, mostly prevalent on the mid-cap domain. But that's this is the area that we still see meaningful amount of growth coming through. So if you divide consumption into three buckets, one is the luxury consumption, second being mass consumption, and third being rural consumption. I think luxury consumption is what I'm talking about, which is still robust. Rural consumption is actually seeing a bit of uptick. Mass consumption is where we are struggling. So the other two parts of the consumption, which mostly falls in the discretionary part, is something that we are positive across in our portfolios. It has played out well, I think, from the way their outlook is seeming to be. One of the hotel companies reported yesterday, they reported fairly robust numbers that go on to show that the segment is doing just quite well.
All right. Hi, Trideep. Good morning. Good to see you in. What's not doing too well is tech. The numbers that we've seen so far haven't been very, very inspiring. The bullish argument is how much lower can these stocks go? Because in the next couple of quarters, the street is factoring in that we'll have a more rational Trump. And, the spends will improve, which in turn will then, give some kind of support as valuations are attractive. Are you in that camp that believes that tech is now getting to that phase where you want to dip in?
Rational Trump might be the the most strenuous assumption that one is making. But jokes apart, I would say that, I would put it IT services actually basing out, if I may use that word. Essentially, if you look at this is the worst possible circumstances of decision making for the clients of IT services, which is mostly in the United States. They don't know what tariff is going to end up like. And what business conditions might end up over a period of time. So in these circumstances, the growth that you see, the outlook that you see is probably the worst possible thing that you can kind of think about, barring a global recession, of course. So in these circumstances, the stance we have taken is we have closed our underweight on the sector. We are broadly neutral across our strategies. And we think that we'll kind of tide out this tariff tantrums to the extent that we can, as close as we can get to the end, and then gradually ratchet up. So the direction going forward might be up rather than down, but at the moment, it'll be more neutral in our portfolios. That's how I would put it. With earnings probably basing out, in this quarter and probably the next one.
Trideep, I was listening to. There are, of course, people like Naren, etc. Again, doyens of fund management industry. There's one view, right? Who've been saying that markets, things are finely priced, things are discovered, things are. And so it kind of limits one's opportunity and upside, etc. So, what you buy, it makes a lot of difference to eventual outcomes in that sense. Are you in that camp, or you think there are still lots of single stock ideas? At the end of the day, you don't have to buy a sector; you just buy one name, right? You think that is available within pockets?
So I think at a broader level, markets are fair value. And if you look at markets in a slightly top-down from a multi-year standpoint, I would say the markets were carried by a capex cycle over the last 3-4 years, pre-election last year. And since the elections, overall, decision-making is just about starting. It's waiting to see the next earnings trigger, or the sector leader, which can take us through to further higher levels over the next 3-4 years. That at the moment ain't visible, which is why the markets are kind of, broadly at similar levels at past. And what we have to do in these circumstances from the near-term standpoint is rely on stock picking ideas in specific niches where demand is still robust, the three sectors that we talked about, till the time we latch on to the next earnings upgrade driver, which, the chances are, if you ask me, could be consumption. But at the moment, we don't see that the triggers for that. But as we get to the back half of this year, we all know that oil has cracked quite a bit. Inflation is down. We do have a bit of a tax breather that's been given by Honorable Finance Minister. Financial conditions have eased. So all of these could turn out to be a meaningful catalyst for consumption, which could be the driver of next earnings upgrade cycle as we get to the back half of this year. And that's what I think the market is waiting for. So till that time that comes through, I would agree that the markets are in fair value. We have to rely on stock picking in niches to tide through this time. and then catch on to the big earnings upgrade driver to hopefully take the markets onwards and upwards for the next 3-5 years.
Tradeep, so finally, tell us, have you been undertaking any major portfolio changes? What are you doing? Any churn? Given the kind of market that we're in, it's range-bound, it's consolidating, and there are only very few pockets of earnings growth. So, what are the changes that you've undertaken, and what would the advice be to investors?
I think at the moment, the advice to the investors would be there are three ways to invest in market at any point in time. One is a lump sum. Second is basically an STP staggered over a period of time. And third is buy on declines. My read on the market currently is that it's a buy on declines market rather than the other two that I talked about. That's one way to think about it. The second way to think about it is, we believe that markets are at broadly fair value. The way to outperform markets is basically bottom-up stock picking in and around the niches. So the three sectors the three segments that I talked about. Apart from that, we've increased our weightage a bit in the chemicals space, where we think that certain specific fluorination, etc., could be going through a bit of a earnings rebound over the next 3-5 years. So that's another area that we have added on to. IT services, we have closed our underweight, taking advantage of this weakness to go to more neutral oriented stance. And finally, in consumer discretionary, we have added on to certain sectors or certain segments where we were not overweight. So those are the three areas that we have gone overweight. The areas that we have gone light on would be commodity-led sectors. We think that given there is a deflation in China going on, overall, that will kind of keep that side of the equation broadly in a bit of a headwinded environment. So that's the reason we have taken a bit of weight off from the commodity-related sectors.
Okay, all right, understood. Thank you for that perspective. It's helpful, Tradeep, and thank you for being with us this morning as well. We look forward to another session soon on this one. Well, with that, let's actually move on. Markets not done much at all. Quick check before we get our next discussion going. We're about 17 points lower on the Nifty, so nothing's really changing. The spotlight next is on the banking space. The Bank Nifty is right now down about 0.25%. Now, several things that we're tying in together with this discussion. First and foremost, the RBI governor's statement that came through. Mr. Malhotra, in his comments to CNBC-TV18 in the interview that you heard earlier this week, said that not allowing foreign banks to own 26% stake in Indian banks, quote unquote, defies logic. We'll try and actually play that soundbite out. It's a very strong statement coming in from the RBI governor himself. So that's one development. The other piece is that our colleagues in New Delhi are picking up that there seems to be a view forming in the government that perhaps it's time to consider further consolidation of PSU banks and maybe even allow raising the 20% foreign investment cap on PSU banks. So basically turbocharge state-run banks from here on. Now, what could this mean for the banking landscape? And of course, for investors, how should they be looking at the banking sector? To talk about this, we have with us Abhizir Devanji, founder of Neostrat Advisors, and Mr. Dinesh Khara, former chairman of State Bank of India. Gentlemen, thank you so much for joining in. And let me actually start with the latter part. This whole idea that do we really need to turbocharge now PSU banks? Mr. Khara, of course, and the market really acknowledges it. We've been having these conversations with the analysts since the morning, and everyone is acknowledging that PSU banks are now really almost giving the private guys a run for their money. The growth numbers are looking good. For SBI this year, the street estimates growth of 12-13%. And there's this big fundraising exercise, a QIP that's happening. How would you describe the PSU banking landscape? Should it just continue as is because things seem to be going fine? Or is this the time to actually look at bigger changes like consolidation?
Well, when it comes to PSU banks, of late, there is a remarkable change in the way they are being managed. And also, they have got a natural advantage in terms of their network. So I think considering the fact that there's an adequate appreciation for the risk management, considering the fact that they have got the ability to raise money from as far as deposits are concerned, they are very well capitalized. So I think these are some of the positives which have to be seen. And also the other important aspect is that they have been performing consistently well. So it actually means that there is some kind of a strategical change in the way these banks are being managed. So I think this has to be kept in mind. And also Now, I think last quarter, we have seen that when it comes to the quality of the balance sheet also, the public sector banks' balance sheet looks much better as compared to the private sector banks. So, I mean, if at all you put all this together, then certainly this is one segment of the banking sector which the country should be proud of. And also, I'm sure the investors also have also taken benefit of the money which they invested into these banks.
But the question is that whether this is the time to look at consolidation or not, because some of the smaller PSU banks, they've also been doing a great job of, managing and pushing growth. I mean, case in point would be, let's say, a Bank of Maharashtra. I mean, the other day I was reading a report, an analyst report, someone pointing out that they are as aggressive as any, private sector name, if not more, and growth rates have been absolutely blazing. So therefore, the question, let me bring in Abhizir as well. Abhizir, PSU banks are doing great. The credit cycle seems to be, in the banking sector's favor. Is this the time for bigger tectonic reforms and changes?
Well, I think we have been through a bunch of changes when there was a PSU bank consolidation that happened over time. And I think that is bearing fruit now because we have some size now from what we had earlier. I think that size is still suboptimal, and there is still scope for actually increasing that size. And there is still scope for further consolidation. I don't think, we need so many PSU banks or even private sector banks sometimes. We need larger ones. We need more, but we need larger ones. Now, if there is more consolidation, that will always give them more strength. Now, I would say that the PSU banks have started it with the wave of consolidation that we did earlier. Now there is the next wave of consolidation, people who are left out of it. Say a Bank of Maharashtra, as you rightly said. If it's that aggressive a bank, if it is bolted onto another bank which has size and deposits, as Mr. Kara said, then that bank with the management bandwidth and the momentum that it has already gained could do much better if there is a level of consolidation. But consolidation does bring about a sense of pause because there is a integration timeline, which is 8 months to 24 months, which happens. And at this point in time, I think with credit running away the way it is, and especially rural credit, retail credit running away the way it is, we will need to focus on more banks which can do corporate credit, project finance credit. And we will need to move the pendulum back to that from retail because the balance sheets have stabilized. The capitalization is good. Further capitalization can happen as long as it's in the right direction. In my view, that direction should be more of project finance and corporate lending.
Abhizir, why? I mean, I'm just going back to the statement you made that we don't need so many banks. We actually need bigger and larger banks. Why do you say that? When smaller banks are being able to push growth, they're nimble-footed, at least some of them seem to be really making a mark. Why do we need bigger banks? Would that not be an impediment? Because, how do you move a big elephant?
No. So, firstly, smaller banks are more vulnerable. And we are seeing that in the private sector. So in the private sector, you see what has happened to a Yes Bank or see what has happened to other small, mid-sized banks. I wouldn't want to name them. But any shock that hits their system gets them reeling down. Now, banking is a trust business. And in a trust business, unless you have scale, your ability to manage short-term shocks is not there. So scale is required. So Bank of Maharashtra, for example, tomorrow, if it had one shock, it would come down reeling. And it's a great bank and it should do well. So ideally, consolidation is required to bring it the scale to be able to absorb shocks and the trust organization to remain intact. So that is the reason for consolidation, not that they're doing well.
Okay, so perhaps we do need to look at consolidation and maybe this is a good time. Got that. Now, gentlemen, let's move to the other part of the conversation. That's foreign ownership. Always a very tricky and sometimes a very controversial topic in India, right? But the RBI governor made a telling statement that he doesn't see, why there needs to be this 26% cap. Mr. Khara, your thoughts?
Well, I think when it comes to, as of now, the current 26% caps comes from the Banking Regulation Act. And also the fact remains with the 26% voting rights, any resolution can be blocked. So this is what it is. But yes, of course, by talking about this, we have to be very mindful of the fact that if at all we intend to attract the foreign banks to invest into India as a strategic investor, we do experience some challenge. And that challenge essentially comes when it comes to the foreign banks have got a very clear perspective. They would like to invest and also show in their holdco balance sheet also. If at all they don't get the commensurate right of voting, then they have got a challenge, which actually means that we will restrict their investment to 26% only, because voting right, there's a challenge. So that is something which is there. But now, of course, we have to debate whether how much of the foreign banks investment we need in the country. And of course, when it comes to India as a potential investment, there is a lot of interest from the foreign banks, particularly because of the growing size, because of the growing economy. And also, since now we have become the fifth largest, going to be fourth largest. And also we will have a situation where we'll be among the top few economies in the globe. So naturally, all the foreign banks are looking at opportunities, how they can either scale up their presence or they can invest into some such entities through which they can have a significant and decent presence in the country. So I think if at all we will look at it in that context, there's a challenge with this 26% voting right, CD.
And all this happening against a backdrop of SMBC, the Japanese giant, looking to buy a stake in Yes Bank. And I think the last reports that we have are that they're looking for an additional 4.9% stake. They want to have at least 25% stake in the bank. Abhizir, what would your thoughts be? I mean, again, beyond 26% ownership by a foreign bank, has the time come? Because you made that strong argument for why we need bigger, larger and stronger banks.
No. So I personally think that with India becoming now a very large major economy, I think this distinction between foreign banks and domestic banks is kind of unnecessary. As long as Indian corporates and Indian consumers are served with meaningfully large banks. Now let me come to the larger issue. I think the 26% voting cap is generic. It is not meant for foreign banks. It is everybody has this cap, and that is enshrined in the Banking Regulation Act, which I think is due for an amendment. Now coming to foreign banks itself, the restriction is, first of all, is ICICI Bank a foreign bank? It is 74% owned by foreigners. It is. HDFC Bank is it a foreign bank? It is more than 51% owned by foreigners. So these are banks which are owned by foreigners. Now the issue is strategic ownership by foreign banks. Now in that case, RBI has a regulation called wholly owned subsidiaries, which basically says that you can incorporate a wholly owned subsidiary in India, which retains capital in India, shields that capital from global vagaries. And that was the intent. However, and this, by the way, this regulation also allows a wholly owned subsidiary to actually undertake M&A activity and buy local banks. And normally that is not there in the law today, and the amendment that, in my opinion, is required is whether these wholly owned subsidiaries, who then become partly owned subsidiaries by acquiring domestic banks, do they have a 51% or more voting right? Because inherently, they still remain subsidiaries of foreign banks. So a new category emerges where foreign banks are allowed to own subsidiaries in India. And that subsidiary, by virtue of being a subsidiary, needs to have control. Now, RBI has really laid out a principle which says that you will remain a subsidiary as long as you hold more than 51%. And if you are not 100% owned, then you cannot, you have to own between 51 and 74%. That's what it is. And frankly, that needs to be enumerated more in terms of giving voting rights, which is commensurate with the shareholding. Because then that is the true nature of a subsidiary. And what we need is maybe another category now of partly owned subsidiaries instead of wholly owned subsidiaries, which provide good capital, captive capital into India, which and banking sector in India will lack capital if it has to be sizes of scale. I mean, even a State Bank of India, which is really large, is not among the larger banks in the world. How do we make sure when India becomes the fourth largest economy, how do we make sure that we have among the top 5 or top 10 banks? We will need capital. Corporates are not allowed to put in capital. Instead, retail capital is what we aim for. And that is never going to be enough. So in my view, foreign capital ownership owned by foreign banks who set up subsidiaries and captive capital in India need to be enhanced. And for that, the voting cap needs to go so that they have voting rights commensurate to the capital they hold.
Very, very comprehensive explanation. Abhizar, really great to hear that. Prashant here, just one last brief question. We're already sort of running out of time. Mr. Khara, it was great to, by the way, see you yesterday evening at the CNBC-TV18 Prime event. Just one thing, and this goes directly to what we are picking up from a lot of bankers we speak to. And bankers tell us that when they go for sessions with the RBI, when the RBI invites them to ask for feedback, etc., it's very, very clear that, they want to really push growth, focus on growth in a big way. I mean, the question is, what do you need, right? And they're willing to sort of give old sort of legacy rules, limits, etc., relook. In your opinion, Mr. Khara, 30 seconds, if you can lay out what will, get this to jumpstart this credit cycle. What are the one or two measures which are the maximum bang for the buck?
I think as far as RBI and the banking system is concerned, they are very well geared up to really support the growth. But now I think that when it comes to demand from the corporates, we need to really get to see that. And I would also mention that when it comes to infrastructure kind of projects, there is enough demand which we get to see. And there's a lending also happening. But when it comes to the larger, broader ecosystem in terms of the corporates are concerned, they're probably now saddled with a lot of liquidity in their balance sheet. They have also raised money through various other alternate sources like equity and also the bond instrument.
Sure.
So that is supporting their growth initiatives.
Fair enough. So the demand, supply is there, demand needs to happen. Abhizar, you agree or you have anything to add on this point?
No, absolutely agree. I think corporate demand needs to pick up. And the banks are ready to lend, in my opinion.
Okay, got it. Well, the stage is set. Both of you are telling us. Mr. Khara and Abhizar, great to have both of you here, gentlemen. Appreciate your time on CNBC-TV18. Really great conversation as always. Time for a special segment, Quarter Se Quarter Tak. Nigel has walked over to the big wall and we are telling you what to expect from the cement space today. Nigel, morning.
Well, morning. Let's get straight to the point then. The quarter is expected to shape up as a strong one for the cement industry. It's going to be aided by a low base, improved pricing discipline, even as volumes remain a little bit tepid. Let's break it down across pricing, volumes and profitability. Now, after 5 straight quarters of year-on-year decline, cement prices have grown in Q1 FY26. Remember, this comes post a marginal 2% increase on a quarter-to-quarter basis that we saw in Q4. And now in this year, in this quarter, we expect to see another 3% increase in pricing. The South, that will lead the way with hikes of around 10%, which will be supported by production discipline, while the East as well saw some kind of traction as recent price hikes were largely accepted by the market out there. But pricing in other regions, you talk about North India, West, it remained more or less range-bound. Now, reports suggest that companies are attempting another hike in July. That's basically to offset the typical monsoon-led pricing weakness that we see. Cement demand, well, growth is expected only around 3 to 4%, primarily impacted by the early onset of monsoons, the sluggish construction activity, particularly in North India, and the India-Pakistan skirmish also weighed on demand in various parts of the border regions. Meanwhile, the central region, well, it held up relatively better. With regard to volumes, Ultratech and Ambuja, well, they'll outshine. But that's because, they have inorganic growth that will be getting factored in as well. So that's why both those two will deliver double-digit growth on volumes. JK Cement volumes, well, that will grow, led by traction in central India. On the other hand, Shree Cement, Dalmia Bharat, Ramco Cement, they're expected to see a flattish to a negative growth number. Now, despite soft volumes, margins will improve, with the average EBITDA per ton estimated at around 1,070, which will be higher by around 40 rupees quarter on quarter, and will be higher than more than 200 rupees on a year-on-year basis. Companies with higher exposure to South India, well, they'll see an EBITDA expansion of around 250 to 500 rupees, while those in North India, as well as Central and West, may see a flattish to a marginally lower margins as well. Remember, the aggregate cost per ton is expected to increase by around 2% sequentially, but that's because of operating leverage, negative operating leverage that will play out. Pet coke price volatility as well as stable coal prices may lead to a bit of an uptick in energy cost. Shree Cement, well, that'll be delivering industry-leading EBITDA per ton. Though on a sequential basis, it'll be a little bit lower. So we're working with a number of under 1,350 rupees. While Ultratech, Ambuja and JK Cement, well, they will gain owing to the operating leverage. South-based players like Dalmia Bharat, they'll benefit from the price-led margin expansion. Well, let's sum things up. Q1 FY26 could be a price-led margin expansion story with demand yet to fully fire due to seasonal and other regional disruptions. The sector appears, though, well-positioned for a better showing in the second half of the year, assuming some of these price hikes do hold out. Well, let's wind this down then with a valuation snapshot that comes up for you on the screen. Let's get in our analyst that we have on the show, Rajesh Ravi, institutional research analyst who joins in. Hi, Rajesh. Thanks a lot for joining in. What are you working with on that EBITDA per ton basis? What is the total increase and which company will outperform on that parameter?
Hi, good morning, Nigel and others. As you rightly pointed out, this quarter, the realization for cement companies have improved sequentially. Second quarter in a row when prices have improved, thereby leading to a YY recovery in cement prices. Most of the price increase has happened in South and East market, which where prices have fallen to decadal lows. So these two markets, EBITDA margins should improve the best sequential basis. On an aggregate basis, we are factoring in 90 rupees EBITDA per ton for the sector as a whole, out of which the South and East-based players should report 200 to 300 rupees EBITDA per ton improvement, Q on Q.
Got it. All right. Rajesh, what about price increases? Finally, we are seeing after many quarters, at least on a year-on-year basis, prices are higher. Q2 will be a little bit softish, but that's seasonal in nature. For the year on the whole, what kind of a price increase are you working with for the sector? And if you could also tell us what kind of demand growth you're looking at, because it'll be low single digits that we'll work with for Q1.
So see, for this, prices have improved for sure, and this was much needed. The South and East market prices had come down to insane levels, mostly because of volume push by cement majors. Now, because everyone is in a bad shape, the profitability had gone in a bad shape for most of the players. Rationality has prevailed or seemingly prevailed, and that is why we are looking at healthy pricing. And we believe that part of the price hikes which have come through should sustain through. However, on a full year basis, we expect that the Q1 pricing should be close to a peak number. We will not be seeing the full year similar margins. So for full year, we are factoring in around 170-180 rupees EBITDA per ton improvement on an aggregate basis. That would still make it the aggregate closer to 1,000 rupee versus 820 odd in FY25. And I believe that is much needed.
Got it. All right, Rajesh, there's this buzz of consolidation in the industry. Let us evaluate this one asset, Deccan Cement. The stock has run up 50% in 1 month. The street is sniffing something. We have seen this in the past, but what's happened in the last 12 to 18 months, some of these deals have actually taken place. So let's just get a fair value for that asset. It appears that the debt in the books is around 600-700 crores, market cap's around 1,500 crores. So we are at around 2,200, 2,300 crores of EV. But also there'll be some capex that will have to be incurred to get the company from a 1.8 million ton to 4 million ton.
Yes.
What kind of assumption can we make on that additional capex? And what is the value you would give it on an EV per ton basis at current reckoning?
So you rightly said this, incremental capex which would be required, which are understanding, from their annual reports and credit rating reports. Another 300 to 400 crore for sure would be due to complete the 2.2 million ton expansions, which has been significantly delayed due to cash crunch. So that makes the EV closer to 2,600 crore on the current spiked up prices. So that already takes the stock to $75 per ton. Given a south-based asset, it will be more of an acquisition of an asset rather you're acquiring any brand, or any other strategic fit. So anyone who would going to acquire this company may not be willing to pay more than $80-85 per ton for sure. Even if you look at the recent acquisitions which have happened in barring India Cements, if you look at all the assets in South and all, they would have happened below $90, so closer to $90, and they're much bigger assets with much bigger infrastructure, even beyond cement, ancillary infrastructure. So from that perspective, Deccan Cement is fully pricing in an acquisition price, which if it happens, we don't see much upside from here. But again, that's quite a guess, if it is going through.
Rajesh, we'll leave it there. Thank you very much for joining us. Quick but punchy chat on cement expectations. We'll take a break. We're back. We have three gentlemen joining us on the other side. And we'll ask the question, should government push public sector companies into the renewable energy sector in a big way? Nikhil Nagania, Shalu Agarwal, Anil Razdan coming up. Welcome back. This is Corporate Radar. NTPC and NLC India are in focus as the government has allowed both to invest in renewable space in a big way. We are now joined by Shalu Agarwal, a Director of Programs at Council on Energy, Environment and Water. We have Nikhil Nagania, Director, Senior Analyst at Bernstein. Mr. Anil Razdan is Chairman, Energy and Environment Foundation. And, of course, he's also the former past Secretary, Government of India. Thanks very much, Shalu and gentlemen, for joining us here on the program. This we can talk about specific companies and maybe Nikhil can address this, but fundamentally, this state-directed push for asking PSU companies, government-owned companies to go into renewables in a big way. I mean, many are doing it in any case. Is that correct? Or do you think it could lead to excesses? Mr. Razdan, you go first.
I think it is the right policy advice because we had in any case committed in Paris that we will have 50% of our installed capacity from non-fossil sources. Our demand for energy is increasing. The climate is getting worse. We are seeing much more unpredictable weather. So I think it is a step in the right direction. But while we are going for renewables, we need to push hard for storage also. Because this being intermittent energy, we need a stable system. And now with EVs also coming in a larger way, I frankly expect even the oil marketing companies to be moving into the space because they want business and they're in the business of energy. And if energy is undergoing a shift in a particular direction, then these companies have to be agile and move forward. Yes, production methodologies differ. You can have that kind of expertise. Companies can always hire that kind of expertise, but they must move with the times if not ahead of the times. Because the problem is not only going to be installation, finding capital for it, but also management. And particularly when you have renewable energy, which is intermittent, weather-related, climate-related, you have to have a battery backup.
No, absolutely. So that point is...
Yet we're doing enough.
Absolutely. So, no, that point is well taken. I mean, the world is moving towards renewables. But the reason why this question becomes very pertinent is that a lot of these state enterprises, they're listed companies, they have shareholders. So then the ROI on this kind of investment also needs to be mapped in. So let me quickly throw this to Nikhil. Nikhil, the numbers are getting bigger and bigger. I mean, just yesterday, I think in the cabinet meeting, an additional 20,000 crores was cleared for NTPC to invest in NTPC renewables. NLC India is being told to put almost 7,500 crores to work on the renewable side. Likewise, ONGC, the oil companies as well. Now, from a shareholder perspective, how should you read into this? Is this going to be very long-term gestation in terms of investments? What about the ROI? How do I look at it as a shareholder of these companies?
Sure. See, I think firstly, the reason why they are doing it, I think two fundamental reasons, as Mr. Anil Razdan also shared. The world is moving towards electricity. So as they say, electricity is the new oil or the age of electricity, as even the IEA talks about it. So electricity is growing faster than energy demand. And the second reason is renewables, which will be the larger contributor of the incremental energy needs, electricity needs, is very capex intensive. So hence, not just utilities like NTPC, but even oil marketing companies are being pushed in that direction. Now coming to the shareholder perspective, so if you talk about returns, at least I can talk from NTPC perspective, which we cover. So renewable projects tend to make equity IRRs in the range of 13-14% typically, or if a complex project, it could be higher, depending on the situation. But that is the growth area. So if you compare it to overall returns, which an NTPC makes, right now is 13% ROE. So it's not return dilutive per se. The return should sustain, but the growth is there. So investors will take it positively as far as NTPC is concerned, and even the subsidiary NTPC Green is concerned. Definitely a positive development, given the capital needed to reach their 60 gigawatt aspiration by 2032.
We talk about industrial policy, right? Making a comeback across the world. Industrial policy right here. Shalu, your thoughts?
Well, I echo, what's been said before me, and I would just supplement it by saying that if you look at NGEL's financials, it's a AAA rating company, it's profitable. So it's not like, the fact is all these decisions are being driven by economics. And, solar along with storage at 90% availability, these plants are already cheaper than any new coal power plant that NTPC can think of building by at least ₹1 per unit. That's a huge margin. So that's a reason why I think this decision has to be seen in the context of where the entire sector is moving. It's not just India, it's the entire world. And I would also say that the decision to expand ability for NTPC to invest, it's giving them more flex. It's not directive to them per se that you must invest this much, because what we have seen over the past, NTPC is also playing the role of market shaper. A lot of prices that NTPC bids have discovered have set the benchmark for the subsequent prices going forward. So I think this decision will help accelerate market making in the clean power sector in the country. And in fact, as per CW's research, where we simulated entire grid for the country for 2030, our research suggests that a higher renewable portfolio in the entire energy grid will help the country deliver more reliable, more affordable, and cleaner power to the people. And of course, this doesn't even count avoiding air pollution, more jobs that can be created, distributed across different parts of the country. So overall, we are moving in the right direction.
The only thing is, absolutely, and I completely agree with it, right? I mean, we've got to do it even if the current president of the United States is calling coal big and beautiful. I think renewable is the future. I think as all of us agree. But it's just the mix, right? What about nuclear? I mean, just to throw that in the mix. India perhaps is one of the few countries building reactors. There are other countries which are coming around. That's clean fuel. I mean, it's just about the mix. I mean, what is needed to achieve this very large base load which India, the demand will generate, will need. Mr. Razdan, just quick closing thoughts, sir?
Yes, there is already a lot of on SMRs, the small reactors. which of course were large, considered reasonably large at some point of time. You need steady baseload power for any system. This is an area that we've got to work on strongly. And we are hopeful that the private sector will also be able to play a significant part in the new renewable scenario. There may be more salt also. But I think the placement of these nuclear reactors will have to undergo the same kind of rigorous profiling and tests, which has been traditional. We've had an excellent safety record, so there's nothing to fear on that count. But we have to move with a strong, reliable base load, and renewables must move with storage. You cannot have intermittent power supply without storage facilities. Otherwise,
Absolutely.
you have fluttering heartbeats all the time in the power distribution system. The transmission lines will have to come up. And India, in any case, you see, we have a land constraint also.
Yes.
And I think in that sense, there may be some limit to renewables unless we start marrying construction techniques, architectural requirements,
Yes.
etc., to a lot of renewable generation placement in our building architecture, also long roads,
Yes.
etc. So
No,
I think
absolutely.
it is all in the right direction. And you talked about the boost to NTPC to invest in NLC. I think it is timely because of late,
Yeah.
because of the fall in the prices of solar energy, private sector investment was waning a bit. So
Right.
we do not want this momentum to come down. So I think it is a step in the right direction that the government has given a direction.
Yes.
I still remember when I was the joint secretary in the power ministry, NTPC had stepped into hydro.
Yes.
And ironically, the name of the project also was Coal Dam in Himachal Pradesh. But NTPC has come a long way from that and from hydro, where sites are reasonably limited and you need a lot of
Yes.
particular domain experience, expertise.
Yes.
They're moving into solar, and hopefully in times to come when wind energy
Yes.
efficiencies improve and we're able to more
Yes.
finely tune our locations and the heights at which we need to locate these installations. We will
But
be tapping
timely
on that.
intervention, timely push from the government. I think that's the consensus here. Mr. Razdan, Shalu, Nikhil, thank you very much. Short conversation. We'll hope that you guys will come back maybe for a longer chat, because this does need a longer chat. And maybe it's a sort of a continued theme, a story which is play out over the next many years as both private and, of course, the public sector, as we just heard, helps in the build out of the renewable infrastructure, wind, solar, and of course, I mean, if you want to call nuclear, of course, it's clean, but power as well. So a fair bit happening there. Mitesh is with us with what he'd want you to do in terms of trades. 10 o'clock. Mitesh, what do you have?
So, Prashant, on the stock side, the cash stock which is come on my radar, which is AWL or Adani Wilmar, good volume and price action over here. So, recommend buying this one around current levels with the stock below 269 and a target of around 300, possibly can below that. And that apart, Torrent Pharma is a buy with the stop at 34.75 and look for a target of around 3600.
Okay, Mitesh, thank you very much for that. Torrent and Adani Wilmar are Mitesh's picks and calls, trades right now. We take a break. Manisha with commodities on the other side.
Welcome back. Well, let's quickly do a snapshot or get a snapshot on the commodity market action as well. We have Manisha joining in with the latest. Manisha, so what are the big headlines today?
Well, I'm looking at the iron ore prices right now, Surbhi, because we haven't spoken about this one in a very long time. And it has been gradually increasing in sense of prices. So much so that when you look at the US iron ore prices, we're trading at almost $100 a ton here. But here as well, as you can see, as has been the case with various commodities, there is a big disparity versus US and the rest of the world. So when you look at the iron ore prices in China, we've seen them gain up by 5.5% in the last 1 week, vis-a-vis 2% of gains in US. And when you look at the last 1 month itself, you can see that gap really strong. 3% of gains in the US market, while 13% of a jump is what iron ore prices have done in last 1 month in the Chinese markets there. Well, one of the reasons, of course, has been the US dollar index, and treasury yields retreating from recent highs has been supportive for many of these commodities. The second point is about the stronger US and China economic data that we've seen in the last 1 week or so. Most of it beating expectations, especially for the Chinese market, and that clearly has been supportive. Easing US and China trade tensions also has led to some boost in many of the industrial commodities, including iron ore. And then you have the China Politburo meeting happening in the end of this month. That would set course for the rest of the year in sense of policies, measures, and the street does anticipate that you could be listening to something in sense of infrastructure, property, and support to steel industry as well. And that is where iron ore prices come into picture. Also, when you look at the overall demand-supply fundamentals, we have seen a decline in inventories on port, especially in China, and there is improved margin on the steel mills supporting prices. The Chinese also have pledged to tackle issues when it comes to property, competition, and outdated capacity. The markets also will be watching out for optimism over potential Chinese stimulus. That is something that has been keeping many of these industrial commodities in favor there. Remember, China is important because it produces 55% of global steel, and Australia is equally important because 60% of all seaborne iron ore comes in from Australia. So keep an eye on both of these.
All right, Manisha, thanks very much. Iron ore in focus. Ixigo is up, flying away, 14%. Mangalam is here just to revisit and shine the spotlight on this name. Mangalam.
Well, an incredible set of numbers coming in from Ixigo. And this time around, you know, the company which is known for having the largest share in train bookings, they had pivoted to increasing their share coming in from, say, something like a travel, via air and travel via buses along with hotels as well. So it's these ancillary businesses that have actually revved up the overall performance of the company. It's led by these newer verticals. The overall revenue of the company is up 73%. The EBITDA is up 54%. Yes, 100 basis points impact on the margins, but the company had alluded to, giving these discounts to amp up their volumes coming in airlines, etc. as well. And even if you adjust for some of the ESOPs, so the EBITDA is actually a lot higher than what was reported. The net profit has grown by 28%. Now, here's where the growth has come from. Flights, the revenue has grown by 150% at 103 crores versus 41 crores. The EBIT out there as well has doubled from 21 crores to 43 crores. In train business, it chugs along fairly at a 29% growth rate, and there has been some margin compression out there, but nothing really to worry if you have 31% margins in that business. Buses, that too has nearly doubled from 40 crores to around 77 crores, and the margins out there have held around that 55% mark. The company's been investing in that business. Hotels and others, which are very small, from 20 lakh that has jumped into 5 crores, and the EBIT out there as well from 6 lakhs has jumped to about 1.8 crores. So all of this put together has the street fairly excited. Their gross transaction value is up 55%. Going into the numbers, the street was expecting that this entire year would be 1,000 crore revenue for the company. Turns out that they might actually outdo that. We'll probably get to know more in just a short bit.
All right, 15 minutes, you'll hear from Alok Bajpai himself, as you can see up on the screen. So don't miss that conversation. Mangalam, thanks very much for that. We'll take a break. It's Indianomics up next. Lata in conversation, and she'll discuss how wide the low inflation number opens the door for rate cuts and liquidity with MPC members Saugata Bhattacharya, Axis Bank's Neeraj Gambhir, and City India Samir and Chakrabarti. Conversation coming up in just a bit.
Welcome to Indonomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indonomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Centre for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, good morning, Lata. Thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, very in a very, very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it will effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards repo rate, which basically means that there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugat, I'm going to ask you 2 quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of prints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack 2 quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? in the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, very, the amount of money that's been raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Bazaar viewers, it'll be chartbusters for you, but you can catch the entire conversation after market hours.